All right, today we're going to tackle one of the most important, but maybe one of the most misunderstood parts of the entire financial world: bonds. Seriously, these things are everywhere, and understanding them is really the key to seeing how money moves around the globe. Okay, so here's the game plan. We're going to start with the absolute basics. What even is a bond? Then we'll take one apart to see its key components. After that, we'll look at who's issuing them, figure out how you actually make money, and finally, we have to talk about the risks. So let's just jump right in. What is this thing that basically underpins the entire global economy? Well, once you strip away all the fancy Wall Street jargon, the idea is actually incredibly simple. That's it. At its heart, a bond is just an IOU, a loan, but on a massive scale. See, when a government or a huge corporation needs to borrow money, they don't always go to a bank. Instead, they can borrow directly from people like you and me. And when you buy one of their bonds, you just became the lender. The deal is actually super straightforward. Step 1, you lend them some money. Step 2, in exchange, they promise to pay you regular fixed interest payments. In the bond world, these are called coupons. And then step 3, when the loan term is over, they pay you back your original investment in full. Simple as that. So to really get what makes a bond tick, let's just look at a real-world example. What's kind of cool is that the name of a bond often tells you pretty much everything you need to know about it. Let's use this one, the 2% U.S. Treasury bond maturing in 2041. Yep, that whole name is packed with info. Each little part of that title is a key piece of data about how this specific loan works.
So first up, you've got the issuer. This one's easy. It's just who's borrowing the money. For a U.S. Treasury bond, well, the issuer is the U.S. government. If it were an Apple bond, the issuer would be Apple. You get the idea.
All right, next up is the nominal value. You'll also hear this called par value, or the principal. This is simply the face value of the loan, the amount the issuer promises to pay you back at the very end. And this is a key point. It's not always the price you pay for the bond today. We'll get to that. Then there's the coupon. Think of the coupon as your reward for lending them the money. It's the fixed interest rate you get every year. So in our example, the coupon is 2%. That means for every, say, $1,000 of nominal value, you're going to get $20 in interest every single year. And finally, you have the redemption date. You can also call it the maturity date. This is the finish line. It's the date everyone agreed on when the loan is officially over and the issuer pays you back your full principal. For this particular treasury bond, that day is sometime in 2041. So, who's actually out there borrowing all of this cash? I mean, who are the main players issuing all these IOUs? Well, while lots of organizations can issue bonds, the market is really dominated by two major groups. On one side, you've got governments. They are some of the biggest borrowers on the planet, constantly issuing bonds to fund everything from new roads to just paying the day-to-day bills. And on the other side, you have corporations. They usually borrow for specific reasons. Maybe they want to build a new factory or expand the business. Okay, now for the big question. How do you actually make money from a bond? It's not always as simple as just collecting those coupon checks, because the price of a bond can and does change over time. This brings us to a super important concept called yield. So the most basic way to look at this is something called the flat yield. It's a quick snapshot of the return you're getting based on whatever the bond's price is today. You just take that annual coupon payment and you divide it by the current market price. And here's where it gets really interesting. Let's go back to our 2% treasury bond. Remember, that 2% coupon is fixed. It doesn't change. But let's say the market price for that bond drops to, $78.12. Well, now your flat yield actually goes up to 2.56%. See what happened? You're getting the same amount of cash, but you paid less to get it, so your return is higher. But here's the catch. Flat yield doesn't tell you the whole story. It's really just one piece of the puzzle. It completely ignores the profit or loss you might make when the bond matures and you get that full nominal value back. And that's where a more complete number, the gross redemption yield, or GRY, comes in. This is the big one. It combines both things: the income you get from the coupons, plus the capital gain or loss you get at the very end. It gives you a much, much truer picture of your total annual return. Now, you often hear that bonds are safer than stocks, and that can be true, but they are absolutely not risk-free. You have to understand what can go wrong. So let's talk about the two big risks every bond investor needs to have on their radar. First up is market risk, and this is probably the most important concept in the bond world. Just think of it like a seesaw. On one end, you have interest rates in the wider economy. On the other end, you have the price of existing bonds. When one side goes up, the other side has to come down.
Here's how that works. Imagine you own our 2% bond. Now, what if the central bank raises interest rates and suddenly new bonds are being sold with a 5% coupon? All of a sudden, your little 2% bond doesn't look so hot, right? So, for anyone to be willing to buy it from you, its price has to fall. This seesaw effect is exactly why the value of big bond funds can swing so much when interest rates change.
Okay, the other major risk is way simpler to wrap your head around. It's called default risk. And it's the answer to a very simple question. What happens if the company or government you loaned money to just can't pay you back? Luckily, there's a system for this. Credit rating agencies analyze how financially healthy an issuer is and give them a rating. And these ratings are basically split into two camps. You have investment grade bonds. These are considered pretty safe. And then you have non-investment grade bonds, which are usually just called junk bonds. And yeah, they're called that for a reason. So let's do a super quick recap. A bond, at its heart, is just a loan. You make money from the interest payments and from changes in the bond's price. Remember that seesaw? When interest rates go up, bond prices go down, and finally, credit ratings are your shortcut to understanding how risky a bond might be. And that leaves us with a final thought. This constant push and pull between risk and reward, between the safety we want and the returns we need, that doesn't just define the bond market. It defines the financial decisions that shape our entire world, from what you pay on your mortgage to how governments decide to spend our money.